What if the money sitting safely in your savings account is not as safe as it feels? Not because the bank is about to disappear tomorrow, not because the world is ending, but because something quieter is happening. Every year, the dollars you hold have to fight against rising prices. Groceries cost more, insurance costs more, rent, utilities, car repairs, medical bills. Almost everything that touches a middle-class household has become harder to absorb. And for millions of Americans, the question is no longer just, how much money do I have? The deeper question is, how much purchasing power am I actually keeping? That is why silver keeps coming back into the financial conversation. Not because silver is magic, not because it guarantees wealth, and not because everyone should rush out and buy it tomorrow, but because silver sits at the intersection of three serious forces: monetary, history, inflation anxiety, and real industrial demand. And when those three forces meet, serious investors tend to pay attention. For thousands of years, silver has played a role in human commerce. Long before modern central banks, stock apps, online brokerage accounts, and digital payments, silver was recognized as money, savings, and exchangeable value. That does not mean the past perfectly predicts the future, but it does mean silver has something most financial assets do not have. It has survived across empires, currencies, banking systems, political regimes, and monetary experiments. Paper currencies depend on confidence. Silver does not depend on a government promise in the same way. It is physical, it is scarce, it is globally recognized, and it has uses far beyond jewelry or coin collecting. That is the first reason many financially aware people take it seriously. The second reason is inflation. Inflation does not usually feel dramatic on any single day. It feels normal at first. A grocery bill is a little higher. A restaurant meal is a little more expensive. A repair bill surprises you. A family vacation gets delayed because the numbers no longer make sense. But over time, inflation changes the meaning of savings. A dollar amount can remain the same while its real-world usefulness declines. This is the quiet problem with cash. Cash is necessary. Every household needs liquidity. Every family needs emergency savings. Every serious financial plan should begin with accessible money for real-life disruptions. But cash alone is not a complete long-term strategy. That is where some investors begin looking at hard assets, assets that cannot be printed, inflated, or digitally created with a policy decision. Gold is the classic example, but silver has a different profile. Gold is primarily a monetary metal and a store of value. Silver is both a monetary metal and an industrial metal. That second role matters. Silver is used in solar panels, electronics, electric vehicles, medical devices, water purification, semiconductors, batteries, and many parts of the modern technological economy. In other words, silver is not only connected to fear about money, it is also connected to demand from the real economy. That does not make silver risk-free. Commodity prices can move sharply. Silver can rise quickly and fall quickly. Anyone who treats it like a guaranteed one-way bet is misunderstanding the asset. But the long-term argument is simple. If a metal has historic monetary value, real industrial demand, limited supply growth, and broad global recognition, it deserves serious attention. One tool many precious metals investors use to understand silver is called the gold-to-silver ratio. The idea is simple. The ratio tells you how many ounces of silver are required to buy 1 ounce of gold. When the ratio is very high, some investors view silver as relatively undervalued compared with gold. When the ratio compresses, silver may be gaining strength relative to gold. Historically, that ratio has moved through different regimes. It is not a perfect forecasting tool. It should not be treated like a crystal ball. But it can help investors ask a useful question: is silver being priced more like a forgotten industrial commodity or more like a scarce monetary asset? That question becomes especially important when inflation concerns, government debt, and currency confidence are all part of the financial conversation. Now let us address the practical question. How much silver should a serious person own? The honest answer is, it depends. It depends on your income, your emergency fund, your debt, your age, your family responsibilities, your risk tolerance, and your overall financial plan. For some people, the right amount may be zero. If you are carrying high-interest credit card debt, struggling with basic expenses, or do not have an emergency fund, silver should not be the first priority. Financial stability begins with liquidity. Before silver, before gold, before stocks, before speculation, a household needs cash for emergencies. 3 to 6 months of essential expenses is a common benchmark, not because it is exciting, but because life is unpredictable. A job loss, medical bill, car repair, or family emergency can force bad financial decisions if you have no cash buffer. Once that foundation is in place, silver can be considered as part of a stability layer, not the whole plan, not a replacement for retirement accounts, not a substitute for income, but a layer. Think of a strong financial life as having 3 layers. The first layer is liquidity. This is cash, emergency savings, money you can access immediately. It protects you from having to sell investments at the worst possible time. The second layer is stability. This is where hard assets may fit, gold, silver, and other durable stores of value. These assets are not meant to make you rich overnight. They are meant to preserve purchasing power and give your financial life a foundation outside the purely digital, paper-based system. The third layer is growth. This includes stocks, real estate, business ownership, retirement accounts, and long-term productive assets. Growth matters. Without growth, inflation can still erode your future. But growth assets can be volatile. They depend on markets, earnings, valuations, credit conditions, and investor sentiment. Many people focus heavily on the third layer while neglecting the second. They own stocks, they may own a home, they may have a retirement account, but they own almost nothing tangible outside the system. That is the gap silver may fill for some people. For beginners, silver ownership does not need to start with a dramatic number. The goal is not to impress anyone. The goal is to build understanding, discipline, and a position that fits your life. A new investor might begin by learning the basics, the difference between spot price and premium, the difference between coins and bars, the difference between physical silver and paper silver, and the importance of buying from reputable dealers. Government-minted coins are often favored by beginners because they are widely recognized and easier to resell. Bars may carry lower premiums, but they can be less convenient depending on size and market conditions. Physical silver has real advantages. You hold it directly. It does not require a brokerage account. It has no corporate management team. It cannot be diluted by issuing more shares. But physical silver also has real responsibilities. It must be stored securely. It can be stolen. It may require a safe, private vault, or insured storage. It can carry dealer premiums when you buy and spreads when you sell. And if you need cash quickly, selling physical metal is not always as instant as clicking a button in a brokerage account. That is why silver should be approached carefully, not emotionally, not because of panic, not because someone online says the system is about to collapse next week, but because you have studied the asset and decided it has a role in your broader financial structure. Some investors accumulate slowly. They buy a small amount each month. They track their costs. They avoid obsessing over daily price movements. They think in years, not days. This approach is not glamorous. But many real financial foundations are built in quiet, repetitive ways. A person who buys a little silver consistently over time is doing something deeper than making a market prediction. They are forming a habit of converting a portion of income into a durable asset. That habit can matter, because wealth is not only built through intelligence. It is built through behavior. The person who waits for the perfect price often never starts. The person who buys too aggressively may create stress and regret. But the person who moves steadily, within a responsible budget, often builds something meaningful without drama. This is where the middle-class investor needs to be especially careful. Silver should not become a financial fantasy. It should not become a replacement for budgeting, income growth, retirement planning, insurance, debt management, or diversified investing. It is not a cure for every economic problem. It is not guaranteed to outperform stocks. It does not pay dividends. It does not produce rent. It does not generate cash flow. And in the short term, it can be brutally volatile. Silver can rise fast when market psychology turns in its favor. It can also fall hard when liquidity tightens, industrial demand slows, or speculative money exits the trade. That volatility is not a flaw hidden in the fine print. It is part of the asset. So the question is not simply, should I own silver? The better question is, what role would silver play in my financial life? If the answer is, I want a small hard asset reserve outside the banking system, that is one conversation. If the answer is, I want to get rich quickly, that is a very different and much more dangerous conversation. Silver makes the most sense when viewed as financial resilience, not financial entertainment. It is a stability asset, a purchasing power asset, a tangible reserve, a hedge against the possibility that the future may not reward people who hold everything in paper claims. And that possibility deserves serious thought. Because today's financial world is built on promises. Bank deposits are promises. Bonds are promises. Currencies are promises. Pensions are promises. Government benefits are promises. Corporate earnings are promises about future profitability. Many of those promises may be honored. Some may not. And even when they are honored in nominal terms, inflation can still weaken what they actually buy. That is why hard assets have never fully disappeared from serious wealth conversations. The wealthy may not always talk about it publicly, but many understand the value of owning things that are not someone else's liability. Silver belongs in that category. When you hold physical silver, you are not holding a promise from a company, bank, or government. You are holding an asset that does not make it perfect, but it does make it different. For the average middle-class American, the most responsible approach is not extreme. First, build emergency cash. Second, reduce high-interest debt. Third, contribute to long-term retirement and growth assets where appropriate. Then, if your financial foundation is stable, consider whether a modest hard asset allocation makes sense. That allocation should be personal. It should be sized so that you can sleep at night. It should not force you to sell during a downturn. It should not depend on dramatic price predictions. And it should never be funded with money needed for rent, food, medication, insurance, or family obligations. A disciplined silver strategy is usually boring. Buy carefully, store securely, keep records, understand premiums, avoid hype, avoid fake urgency. Avoid dealers who use fear instead of facts, and never confuse ownership with certainty. The future is uncertain, that is the entire point. Silver is not about knowing exactly what happens next. It is about preparing for a range of outcomes. A world where inflation remains stubborn. A world where confidence in paper currencies weakens. A world where industrial demand for silver remains strong. A world where tangible assets become more valuable in household financial planning. None of these outcomes is guaranteed, but none of them is irrational to consider, and for people who have worked hard, saved carefully, and watched their purchasing power come under pressure, the question becomes personal. What portion of your financial life is built on things that cannot be printed? What portion exists outside promises? What portion would still be understood as valuable if markets, currencies, or institutions change more than expected? That is the real silver question, not how do I get rich, not what price will silver hit next month, not is this the perfect moment. The real question is, do you have a stability layer? For some people, that layer may include silver, For others, it may not. But ignoring the question entirely is no longer the same as being conservative. In a world of rising costs, high debt, and constant monetary intervention, doing nothing is also a decision. Holding only cash is a decision. Holding only paper assets is a decision. Trusting that yesterday's financial assumptions will work forever is a decision. Silver simply forces a more honest conversation. It asks whether your wealth is measured only in account balances or also in durable purchasing power. It asks whether your plan is built only for good conditions or also for stress. It asks whether your savings are protected in name only or protected in reality, and that is why silver still matters. Not because it is trendy, not because it is dramatic, not because it belongs to conspiracy thinking or panic buying, but because it is real, it is scarce, it is useful. It is historically recognized, and for the right person, in the right amount, inside a responsible financial plan, it can serve a serious purpose. Silver is not the whole answer, but it may be one important piece of a financial life designed to endure. And in times like these, endurance is not a small thing. It may be one of the most valuable financial goals of all. This video is for education and discussion only. It is not personal financial advice. Before making any investment decision, consider your own financial situation, your risk tolerance, your debt, your emergency savings, and, when appropriate, speak with a qualified financial professional. The goal is not fear, the goal is clarity, because the people who protect their financial future are rarely the loudest. They are usually the ones who think carefully, act patiently, and build quietly. 1 ounce, one decision, one layer at a time.